Last Tuesday, gold jumped $145 in a single trading session, the largest single-day gain since November. And if you weren't watching the Middle East over the weekend, you missed why. Gold just touched $408 per ounce. Silver is trading at $94, up from $31 a year ago. That's a 200% plus gain in 12 months. The Dow dropped over 1,000 points Monday morning. Oil spiked 13% to $82 per barrel. And the Strait of Hormuz, the choke point that carries 20% of the world's oil, just got shut down by Iranian military drills. But here's what the financial media isn't telling you. The gold spike isn't just about Iran. The silver surge isn't just about war. And the structural forces driving precious metals higher, central bank buying, Fed balance sheet expansion, and currency debasement were already in motion long before the first missile launched. Today, we're going to break down exactly what's happening. Why gold has doubled in the past 14 months. Why silver hit $120 in January before pulling back to $94. And why the U.S.-Israel military strikes on Iran over the weekend are accelerating a precious metals supercycle that started years ago. Let's get into it. 1. Monday, March 2nd. The day markets woke up to war. Let me paint you a picture of what happened this weekend. Saturday and Sunday, February 29th and March 1st, 2026. The United States and Israel launched coordinated military strikes on Iranian targets. Multiple cities hit, infrastructure damaged, Iranian officials killed, according to early reports. This wasn't a surgical strike. This was sustained bombing across Iran. And Iran retaliated immediately with waves of missiles targeting Israel, Saudi Arabia, and U.S. bases across the Gulf. Then Iran did something that made every oil trader on the planet panic. They shut down the Strait of Hormuz. The Strait of Hormuz is a 21-mile-wide choke point between Iran and Oman. Roughly 20% of the world's oil, approximately 21 million barrels per day, passes through it. When Iran closes it, even for military drills, the global energy market feels it instantly. And this time, it wasn't just drills. Over 100 tankers were halted. 2 ships were reportedly attacked. Oil prices spiked as much as 13% at the Monday open, reaching $82 per barrel, a 14-month high. Then the markets opened, and chaos ensued. Gold surged nearly 2% in the first hour of trading. Spot gold touched $5,400 per ounce, the highest level since late January. U.S. gold futures jumped 2.58% to $5,382. Indian MCX gold futures surged 3.15%, opening at Rs 167th, 217 per 10 grams. Silver participated in the rally. Spot silver rose 1.68% to $95.35 per ounce, before pulling back to $94. Still, that's a massive gain from where silver sat just months ago. The Dow Jones dropped over 1,000 points at the open. The S&P 500 fell. Nasdaq declined. Investors were rotating out of equities into safe havens: gold, treasuries, cash. But here's the thing. Gold was already up 22% year-to-date before the strikes. Silver had already surged from $31 in January 2025 to over $120 in January 2026 before pulling back. The precious metals bull market didn't start on March 2nd. It started long before. The Iran conflict just accelerated it. And if you understand why gold and silver were already rising, you'll understand why the volatility we're seeing now is not a spike. It's the beginning of a multi-year trend. 2. The real reason gold doubled in 14 months. Let's rewind. In January 2025, gold was trading around $2,900 per ounce. By March 2026, it's at $548. That's an 86% gain in 14 months. Silver went from $31 in January 2025 to $94 today. That's a 203% gain in the same time frame. In January 2026, silver briefly touched $120 before correcting. This is not normal. Gold doesn't double in a year unless something fundamental is breaking. And something is. The first reason is central bank buying. Central banks around the world, particularly in China, Russia, India, and Turkey, have been accumulating gold at record rates. They're diversifying reserves away from dollar-denominated assets. Why? Because the U.S. national debt is $35 trillion. The fiscal deficit is running at over $2 trillion per year. And there's no political will to cut spending or raise taxes enough to close the gap. So what happens? The Federal Reserve prints money, they buy treasuries, they expand the balance sheet. They call it maintaining ample reserves or ensuring financial stability. But it's money printing, and central banks know this, so they're buying gold, physical gold, tons of it, because gold can't be printed, gold can't be debased. Gold is the ultimate store of value when fiat currencies are being devalued. The second reason is inflation. Official U.S. inflation might be cooling on paper, but real-world prices are still elevated. Food, energy, housing, all remain significantly more expensive than pre-pandemic levels. U.S. producer prices rose 0.5% month over month in January 2026. Service prices increased 0.8%, the most since mid-2025. That's before the oil shock from Iran. That's before energy prices spiked 13% on Monday. When inflation is persistent and interest rates are still relatively low in real terms, gold becomes attractive, because gold historically holds its purchasing power through inflationary periods. The third reason is geopolitical uncertainty. We've had Trump's first term, the Venezuela operation where Delta Force captured Maduro, threats to annex Greenland, now military strikes on Iran. The world is more unstable than it's been in decades. When geopolitical risk rises, capital flows to safe havens, gold, silver, assets that can't be frozen, sanctioned, or confiscated by governments. All three of these forces, central bank buying, inflation fears, and geopolitical instability, were already in motion. The Iran strikes on the weekend didn't create the precious metals bull market. They accelerated it. 3, silver, the leveraged bet on chaos and industry. Now let's talk about silver, because silver is where this gets volatile. Gold went from $20,900 to $5,480. That's 86%. Impressive. Silver went from $31 to $94. That's 203%. And in January 2026, silver briefly hit $120 before correcting. That peak represented a 287% gain from the 2025 low. This is the silver phenomenon. Silver is smaller, thinner, and more volatile than gold. When fear enters the market, silver amplifies the move, both up and down. CBS News reported that silver surged as high as $120 per ounce before pulling back to today's price of about $94. That's a $26 correction, or roughly 22% in just a few weeks. Gold doesn't move like that. Silver does. But silver isn't just a safe haven, it's also an industrial metal. And that creates a unique dynamic that gold doesn't have. Electric vehicles need silver, solar panels need silver, semiconductors need silver, 5G infrastructure needs silver. According to industry reports, global solar photovoltaic capacity is expected to reach 2,849 gigawatts by the end of 2026. That's massive industrial demand. The silver market has been in a supply deficit for years. Industrial and investment demand consistently exceeds mine production and recycling supply. Inventories at exchanges like COMEX and Shanghai are declining. That creates supply pressure. Now add war, add safe haven demand, add investors panic buying physical silver, silver ETFs, and silver futures, and you get a price explosion. Analysts are now forecasting various targets. Bank of America's Michael Widmer stated that silver prices could fluctuate in the range of $135 to $309 per ounce before the end of 2026. JP Morgan is more conservative, but still bullish. The logic is based on the gold to silver ratio. Right now, gold is at $5,338 and silver is at $94. That's a ratio of 57.5.1. Historically, during precious metals bull markets, that ratio compresses. In 2011, it hit 32.1. If gold reaches $6,000 and the ratio compresses to 50.1, silver is at $120. If the ratio hits 40.1, silver is at $150. This is mathematical. If gold keeps running and industrial demand stays strong, silver has to follow. And because silver is smaller and more volatile, it overshoots. Silver broke through $93 on March the 2nd. The next psychological resistance is $100. If $100 breaks decisively, there's limited resistance until $120, where it peaked in January. And if geopolitical tensions escalate further, we could see new all-time highs. 4. Iran, oil, and the inflation shock markets aren't pricing in. Let's talk about what happens next. Because the market is not fully pricing in the second-order effects of this conflict. Oil jumped 13% on Monday to $82 per barrel. That's significant. But that's just the immediate reaction. The real question is what happens if the Strait of Hormuz stays disrupted. Iran shut down the strait for military drills in February 2026, according to reports. This weekend's closure is more serious. Over 100 tankers are halted. Ships have been attacked. This is not a drill. This is a blockade. Wood Mackenzie analysts have warned that oil could hit $100 per barrel if the closure persists. Goldman Sachs has calculated an $18 per barrel risk premium is already priced in. But if the disruption extends beyond a few days, that premium could double. If oil hits $100, inflation spikes. The Fed's entire narrative about controlled inflation collapses. Consumer prices surge. Energy costs feed into everything. Transportation, manufacturing, food, heating, everything. U.S. producer prices already rose 0.5% in January before this oil shock. Service prices rose 0.8%, the most since July. That's the baseline. Now add a 20% plus increase in oil prices. The Fed has two choices. Raise interest rates to fight inflation, or keep rates steady and let inflation run. If they raise rates, they risk crashing an already fragile economy. The stock market, already down over 1,000 points Monday, would likely sell off further. Recession becomes probable. If they keep rates low, inflation accelerates. Real yields, the difference between interest rates and inflation, go negative. And when real yields are negative, gold and silver thrive. Swap markets have already scaled back expectations for Fed rate cuts in 2026. The market was pricing in 2 cuts. Now that's in doubt. Higher oil prices mean higher inflation. Higher inflation means less room for the Fed to cut. But here's the paradox. Higher rates are supposed to be bearish for gold because gold doesn't pay interest. But in an inflationary environment with geopolitical chaos, gold doesn't care about nominal rates. Gold cares about real rates. And gold cares about trust. And trust in the dollar, in the banking system, in the Fed's ability to manage this mess without printing more money is eroding. 5. The historical playbook. What war does to precious metals. Let me show you the pattern because this has happened before. And the results are consistent. During the 1970s, oil crises and Middle East instability, gold surged from $35 per ounce to over $800. That's a gain exceeding 2,000%. The catalyst was a combination of oil shocks, inflation, and monetary debasement. After the September 11th attacks in 2001, gold jumped 6% in a single day. It continued higher for months. Over the next decade, gold rallied from around $270 to $1,900 by 2011. During the 2008 financial crisis, gold initially dipped but then rallied from $800 to $1,900 by 2011 as central banks printed trillions in quantitative easing. The pattern is clear. When you combine geopolitical shock with monetary expansion and inflation fears, gold explodes. We have all three right now. The US-Israel strikes on Iran are the geopolitical shock. The Federal Reserve's balance sheet expansion is the monetary component, and oil spiking to $82 is the inflation catalyst. And it's not just retail investors buying. Central banks have been accumulating gold at record rates. China, Russia, India, Turkey, all loading up on physical gold. According to multiple reports, central banks globally have been net buyers of gold for years. This institutional demand creates a floor under prices. Every dip gets bought by central banks with multi-decade time horizons. They're not trading, they're accumulating. The combination of central bank buying, war-driven safe haven demand, and potential Fed balance sheet expansion creates a structural tailwind for precious metals. Experts are forecasting gold reaching $5,500 to $6,000 in 2026. Some analysts project higher if the war escalates or inflation spirals. JP Morgan has identified gold entering a structural repricing phase with long-term targets as high as $6,000 per ounce. These aren't fringe predictions. These are institutional forecasts from major banks. 6. What this means for portfolios. Wealth preservation, not speculation. Okay, let's get practical, because this isn't just about charts. This is about wealth, purchasing power, surviving what's coming. If gold hits $6,000 from current levels of $548, that's an 11% gain. If silver hits $120 from $94, that's a 28% gain. Those are meaningful returns, but more importantly, gold and silver are wealth preservation. When currencies debase, when governments print money, when wars disrupt supply chains, precious metals hold value. Gold doesn't make you rich. Gold keeps you from getting poor. Here's what's happening in equity markets right now. The Dow dropped over 1,000 points Monday. Stocks are selling off. Investors are rotating out of risk assets into safe havens. The gold to S&P 500 ratio is increasing. That's a signal that capital is moving from equities into gold. This is a defensive rotation. This is fear. Even treasuries, normally a safe haven, are under pressure. Why? Because investors are worried about inflation. Higher oil prices mean treasury bonds lose purchasing power. So even in a risk-off environment, bonds aren't providing the protection they usually do. Where does capital go when stocks are falling, bonds aren't working, and inflation is rising? Gold and silver. Financial experts recommend allocating 5% to 10% of a portfolio to precious metals. Not 50%, not 100%, but enough to provide diversification and a hedge against monetary debasement. Different ways to gain exposure exist. Physical gold and silver ETFs, mining stocks, gold IRAs. Each has trade-offs in terms of storage, liquidity, and costs. But the underlying principle remains. In a world of $35 trillion in U.S. debt, persistent inflation, and escalating geopolitical conflict, having exposure to assets that can't be printed or debased makes sense. 7. The uncomfortable truth. The system is fragile. Here's what most people don't understand. The Iran conflict is a symptom, not the disease. The disease is a global financial system built on unsustainable debt. U.S. national debt is $35 trillion, over 120% of GDP. The deficit is running at over $2 trillion annually. There's no realistic plan to fix it. So what happens? The Fed prints money, they buy treasuries, they expand the balance sheet. In early 2026, the Federal Reserve announced it would begin expanding its balance sheet again after 2 years of quantitative tightening. They committed to buying $40 billion per month in Treasury securities through April, potentially $20 to $25 billion per month thereafter. That's $300 to $375 billion in new Fed purchases in 2026. That's money printing. Call it maintaining ample reserves. Call it ensuring financial stability. But it's expanding the money supply. Every dollar they print dilutes the value of every existing dollar. Savings lose purchasing power. Paychecks buy less. Prices rise. This is monetary debasement. The Iran conflict accelerates this. Defense spending surges. Reconstruction costs. Energy price shocks feeding into broader inflation. All of this forces the government to spend more and borrow more. And when governments borrow more than markets can absorb, central banks step in and buy the debt. More money printing, more inflation, more reason to own gold. We're still early in this cycle. Gold is up 86% since January 2025. That sounds like a lot. But in the 1970s bull market, gold went up over 2,000%. In the 2000s bull market, gold went from $250 to $1,900, a 60% gain over a decade. If this is the beginning of a multi-year precious metals supercycle driven by monetary debasement, geopolitical instability, and persistent inflation, current prices could look cheap in hindsight. The Fed is trapped. If they raise rates, they risk recession. If they keep rates low, inflation persists. If they print more money, gold goes higher. If they don't print, the banking system and treasury market face stress. There's no easy option, just difficult trade-offs. And investors are realizing this. That's why gold surged 2% Monday. That's why silver is holding above $90 despite extreme volatility. That's why central banks are buying record amounts of physical gold. 8. Final thoughts. The volatility is the signal. So here we are, March 2nd, 2026. Gold at $548, silver at $94. The United States and Israel just bombed Iran. Oil spiked 13% to $80. The Strait of Hormuz is disrupted, and the Dow dropped over 1,000 points. The financial media is focused on the war, missiles, airstrikes, retaliation. They're missing the bigger story. The bigger story is that the financial system is fragile. The dollar's reserve status is being challenged. Central banks are diversifying into gold. Inflation is persistent. Debt is unsustainable. And geopolitical stability is deteriorating. Gold and silver aren't rising just because of war. They're rising because the system that has kept fiat currencies stable for decades is reaching its limits. The volatility in precious metals isn't noise. It's a signal. It's the market screaming that something is breaking, that trust is eroding, that the assumptions underpinning modern finance are being questioned. Last Tuesday, gold jumped $145 in a single session, the largest single-day gain in months. Monday, it jumped another 2% as Iran closed the Strait of Hormuz. This isn't random. This is pattern. Gold knows, silver knows, central banks know, oil markets know, and now you know. The question isn't whether precious metals will keep rising. The question is whether you'll position yourself before the next leg up, before $6,000 gold, before 120 plus silver, before the crowd realizes what the smart money already figured out. The conflicts are escalating, the debt is growing, the money is printing, and the metals are screaming. Are you listening? Thanks for watching. If you want to understand what happens when fiat currencies collapse, check out our video on the Weimar hyperinflation. And if you think gold is expensive at $5,400, wait until you see what it costs when trust in the dollar breaks completely. Hit like, hit subscribe. And remember, in a world of infinite debt and money printing, gold and silver aren't speculation. They're insurance against a system that's running out of options.